Let me show you how we look for trades on a platform or how we place an order here. Oh no, that's for later in the video. Let's get this video started and let's talk about trading. Let's talk about some common mistakes when using your price action trading. Avoid these mistakes, guys. Hey, for those of you who don't know me, I'm Rob, and for those of you who do, welcome back. Good to have you back on that channel, man. I want to talk to you about a few things that people do when they're trading in the markets and the mistakes that you make on a regular basis all the time. We're going to go to the charts today and I'm going to show you the system on the charts. But one of the biggest mistakes that traders make, particularly when they get into trading, they get into price action trading, the courses they go on and all the rest of them, the biggest mistake they make is they believe that a system's going to make them money. They believe that the squiggly lines, that a chart, that a price action system, or maybe an indicator is somehow going to make them profitable. When at the end of the day, they're completely wrong. The actual thing that you need to become profitable in the market is pretty simple. You need a business plan and you need a strategy. So after we've been to those charts and we've had a wee look at what can make you a high probability trade, then we'll go over the strategy that's going to keep you in the game. That's at least going to make you a break-even trader, if not, imagine, a profitable trader. Because I always tell traders, you know what? The market's a 50-50 game. The market is a 50-50 game. I get a lot of flack for this. But why would it be a 50-50 game? I've got a system that's supposed to give me a 70% win rate, a high probability. Yeah, well, as one comment was given to me the other day, it's only high probability until it's not high probability, something to that effect. And he's right, totally right. You telling me exactly what I'm telling you, that the market is 50-50. And the reason it is because the market's not made up of lines, it's not made up of algorithms, and it's not made up of maths. The market is more subjective than you can imagine. It's made up of human beings. It's made up of people that want to buy and sell their stock. It's made up of people that want to buy or sell a stock with the view to making a profit in the next 5 minutes, the next 5 years, the next month, who knows. But that person didn't buy it to make a loss. 100% of traders in the market, guess what? They actually want to win. They actually want to win in the stock market. Imagine that. Can you imagine that everybody actually wants to win and nobody wants to lose? And you think that you somehow got a system that's going to give you that edge, that 7 out of 10 trades or that 8 out of 10 trade winning streak. You see, that's the next mistake that every single trader always makes, is they believe that every single trade they take is going to be a winner. They think that if I take this trade, it's going to win because I've got this special system. I went on a course and I paid thousands of dollars for this course, man. I paid so much money for this course. Surely it's going to win more than it loses. That's the belief. That's what you believe. And that's what you think is going to happen. But unfortunately for you, the world doesn't work that way. So firstly, don't believe a system is going to make you the money. Then don't trade on FOMO. FOMO stands for fear of missing out. If you've got a fear of missing out, you're going to lose money in the stock market or Forex or commodity trading, whatever type of trading you do. I've traded every single different type of instrument out there. I've got investments and I've done different time frames. And let me tell you something, guys. Here's a statistic for you, by the way. 60 to 80% of traders lose money in the markets on trading, on gear trading, on swing trading, position trading. That's daily or 4-hour or 1-hour charts. If you're day trading on 5-minute charts and 15-minute charts, guess what, guys? 99% of traders lose that. And you'll say, rubbish, nah, no chance. It's a human thing, psychologically, a human thing to believe that it's not going to happen to you, that it can't happen to you. That's why we don't wear seatbelts in cars, because we think, well, why should I? Because it's never going to happen to me, is it? It's like when you're riding a motorbike. I'm never going to fall off this motorbike until you do. That's the problem. So trading on FOMO is a big problem. And FOMO can give you a lot of hassles. For example, you're in a winning trade and you're thinking, I've got a bit of a profit here. But the fear of missing out kind of works in reverse as well. So you're in a profit. You're scared of losing that profit. You're scared of losing that small profit. So instead of letting the trade run, to where you wanted it to, you get out of the trade early. It's a sort of form of FOMO, or you see a trade running away, you see it jumping up, and you think, oh, I can't let it go without me. You jump in, and what does it do? It goes against you. Particularly when news events happen, you're in a trade, it comes back, and you actually have a stop loss. You're actually a good trader. You got a stop loss, and it comes back, and it takes out your stop loss, and then it starts going back up the other way. FOMO kicks in, you jump back into the trade. It's called the revenge trade. You get back into the trade, and boom, it comes back down again and takes you out again. Don't you just love that? That's trading, guys, and that's the mistakes that we make. But on the charts, I'm going to show you the mistakes that we make in the price action itself, the actual mistakes that we make when we're trying to run the system. But understand, guys, you don't make money from a system. You don't make money from a price action system. You make money from a strategy. So after the charts, please watch after the charts, because it's the most important part of the video, where I'm going to show you the strategy that's going to make you rich in the future, that's going to give you at least break-even trading or positive trading, because the system won't give you that. All the courses that you go on, all these courses that you've paid huge gargantuan amounts of money for, I don't know how much you pay for courses, but these courses that you've paid for, all they do is they teach you a system that'll give you some form of high probability trade. Only for you got a high probability trade. Doesn't mean you're going to win anything in the market. A win rate is meaningless. A win rate's meaningless because you can take 10 trades and you can have a win rate of 8 out of 10, and you go, ooh, look at me, I've got a win rate of 8 out of 10. Ha, look at my course, look at this, that. And the guy sold it to you, showing you all the Lamborghinis and all the fancy stuff, and you believe that this is the way to go. But you don't look at the fact that the 8 trades that you won you $10 each, and the 2 trades that you lost you $2,000. So you way in the red, and somehow you think this is a win. But it ain't. It's not a win. Guys, let's go to the charts. Let's go and have a look at the price action system. Let's go and see what kind of mistakes you could make trading on price action. And then I'll show you the strategy to making money in the markets. Now I'm going to talk to you about the mistakes we make when price action trading. I mean, obviously, believing a system will make you money is one of the biggest mistakes. As I told you earlier, it's amazing how many people believe that a system like this will actually make them the money, when actually it's the strategy. So guys, after these charts, you've got to go and listen to the strategy. It's so important. That strategy is the only thing that's actually going to make you money in the long run. This system is a high probability trade. This is what everybody is trading, a high probability. Whatever system you've got will give you a high probability of trading in the market, but it's not necessarily going to give you the win that you're looking for or make you profitable. You might have a win rate. That doesn't make you profitable. That just gives you a win rate. So believing that a system will make you money is your biggest mistake. The biggest mistake. You have to understand that making money is about you. It's about your business plan, and it's about your strategy within the market. That's what's going to make you the money. And I'll tell you after the charts as well, and I've probably told you before the charts as well, that you don't trade on FOMO. You don't trade on a fear of missing out, because a fear of missing out is also going to cost you money in a really big way. Not holding your wins, part of FOMO, going to be a really big issue. It's all about controlling your mind, guys. It's all about the psychology of trading. Many people will tell you that it's not. Many people will tell you that the market is not 50-50. But believe me, guys, the market's more 50-50 than you will ever understand. It is a subjective place because it is full of traders. One of the biggest mistakes we make when we're trading is drawing too many lines. What I've drawn here is rather simple. This is simply support and resistance that I've taken off the day. Now, you guys that have watched my videos before know exactly how we do this. So I don't think we really need to go over this in detail. We go to the day chart, we get our resistance. We go to the day chart, we get our support. We draw in a trend, if there's a trend, and we work against that trend. But one of the biggest mistakes I've seen a lot of traders make is they draw a million trend lines, for example, or a million horizontal lines on their charts. They go and they just grab horizontal line after horizontal line after horizontal line after horizontal line after horizontal line. Am I saying that a lot? Yeah. You see, now I've only drawn 1, 2, 3, 4 in here, right? Those 4 lines are so confusing. Where do you start? It's like going to drive your mind crazy. And every time it hits a line, you think, oh, it might hit the next line or the next line or the next. It's going to drive you out of your mind. Too many things on the charts. And then what do? You go and add an MACD crossover. Nothing wrong with that. But now you've added that in as well. So now your chart's smaller. You've got this on the bottom. Oh, no, that's not enough. I'll tell you what. Let's go and add in. Let's see. Let's go and add in a stochastic or an RSI. There's a stochastic there. We'll add that in as well. We'll just add that in for the sake of it. Now you've got even more stuff on your chart. And now they're starting to work against each other because this one's going up and that one's going down. And now you're not really sure because you thought you were going to go long, but that's going short. And then it's hit that there, so that could be going short. So maybe it's going short. Maybe I should go short on this. And then you start working against yourself. Effectively, I see a lot of traders make this mistake. Now look at how nice it looks if I take it all off. Now I take it all off. And now I look at this and I say, right, there's a quick line telling me, just a short, quick line on the 4 hour telling me, look, yeah, this is a bit of a support. It's broken through that support. This is that far away from the resistance, that far away from the support. There's quite a good risk to reward here. Maybe I should take a short trade on this and go short down to the support because this looks like a pretty good risk to reward to the short side. The market's 50-50. Whatever you do, you're going to have a 50-50 trade. So the biggest mistake people make, drawing too many lines on the chart, putting too much stuff on their charts, it just is quite insane. The next thing that you guys need to avoid is only using the candles instead of the lines. Whenever I want to draw my support and resistance in, I will normally go to the day chart and then I will take it to a line chart. And the reason I'll take it to a line chart is because the line chart gives you closing prices, and then the closing prices give me a better picture of where this is going. This is in a range, but it also gives me a clear picture of where it's going. And then I can draw, for example, my short term. Now, if I want to do that on the 4 hour, I can do that as well. I can draw in my short term support line, support trend based on closing prices as well. Then what I'll do is take it back to the candles. Now, the next mistake I see a lot of people making is they change the color of the candles to either all the same, black and white, green and blue, or whatever the case. And they think it's psychologically good for them. And there are traders that like to do that and that can trade like that and know how to trade like that and have been doing it for years. If you've been doing it for years and you know which one's up and down, that's fine. If you haven't, do be aware that you need to know when a trade's going down and you need to know where a trade's going up. Now, you identify red with danger, you identify green with good, because that's the psychology of it. And that's probably why you want to change the color. But believe me, if you change the color of the red candle to blue, then you're just going to identify blue with danger. That's all. Nothing else. You're not going to change anything. Now, it's so much easier for me to keep them green and red, because if I see a green candle going up, coming out of an area, then I know that's a positive signal. It's going long. And if I see a red candle coming out of a resistance, I know that it's going short. And I take long and short trades. So there's no danger for me. It's effectively, if it's going that way, I'll take that trade. If it's going that way, I'll take that trade. I just need to see which way it's going at a glance. And I find that the red and green is so much better at a glance because it's colors that we can see, colors that our eyes identify with quite easily, and our brain identifies with it almost immediately when you see it. You can see a red candle. The other mistake you make is you only use the candles to trade. Now understand that only using a candle to trade, if you're trading on the 4 hour, it's only valid for the next 4 hours. If you're trading on a 5 minute, it's only valid for the next 5 minutes. Each candle is only valid for the next candle, not for the overall trade. What I identify with candles is the size of the candles, because the body tells me how strong the move is. The tails tell me that there's a whole bunch of buyers getting back in, or there's a whole bunch of sellers getting back into the market. And it identifies where the tops are, the pincer tops, The undecided candles like these, where there's a little body in the middle and long tails on either side, tells me that it's undecided. That's effectively all I use the candles for. I don't really use them for much else because they kind of only tell you what's happening for the next candle. I will use the hammers. I like the hammers because they kind of identify which way. But what's a hammer? It's basically telling me all the sellers have come back into the market. That's an inverse hammer. Or the other side, a normal hammer going up, will tell me all the buyers are coming back into the market. It's a simple thing. It effectively just tells you what's happening. Nothing else. Nothing unusual. Nothing untoward. And then that's why I say my next one is getting overcomplicated. Don't overcomplicate it, guys. Don't go insane with this. There was one big thing in the markets recently. It was ICT and all that. They were going mad and everyone was very popular. All of these price action systems are very much based on pretty much wick-off from the old days. And even that is overcomplicated. You've got to wait for it to get down, get up, get down, get up. There's nothing overcomplicated about trading. This system's not going to make you money. The market's a 50-50 game. What you're waiting for, it breaks through an area like this, for example. Okay, this didn't break through. This hit the support and came back out. Same thing, or if it broke through. You're looking for a green candle out of that. Now it's going up. It's going up from the support. Now it comes back, retests, and it keeps on going up. Goes up, goes up, goes up, goes up. It hits resistance. You get a big red candle coming down. Whoa, sell. There it goes. Selling it down, selling it down, selling it down. Same goes for the trend resistance. And the trends are actually even easier because if it breaks through the trend, resistance, then it's short. It's changed direction and it's going down the other way. How can I show you this in a nice one? I think the Aussie dollar, US dollar at the moment gives us a nice picture of that. There we go. Perfect picture. What we've got on the Aussie dollar, US dollar is a very nice picture showing us. I always struggle with these sizings and whatnot. But anyway, there you go. There's a very nice picture. So what you've got here is the Aussie dollar, US dollar was going short for a really, really long time. Short. Never getting above that trend resistance on the way down. And then suddenly it hit a point where it turned around and it broke through that trend resistance. Now it's heading to the upside. That turns it into a bullish trade. At this point where the green candles have gone through, that's a buy. That's where you buy it. You buy it and it goes up. What you do is you draw another trend in along this way, a short-term trend. If it comes back and breaks back through that, then it becomes a short trade. Back again. That's as simple as it gets for the trends. So the trends are the same as the normal supports. At the moment, we've got a New Zealand dollar, US dollar trade in here, which is going quite well. You see what we've done here? We've taken that trade. Now, what you want to do is just grab that. Just want to make sure that this trend line is in its right place. So there's the short-term trend, just to keep an eye on it, because it's now broken that resistance. It's going to the upside. It's staying above that trend line. That trend line needs to be yellow because I don't like them in purple. What it's doing is it's telling me that it's staying strong, staying to the upside, and staying very bullish. And that's it. Don't get overcomplicated. Don't overcomplicate it. Don't look for gaps. Don't look for fair value gaps. Don't look for all this stuff in the market. Just keep it as simple as you possibly can. Manage the risk. Have a stop loss, have a take profit, and walk away. Let the trade play out. As I say, listen to my strategy after the charts, which will explain to you how to follow these trades, how to stay with these trades, how to make a profit in the markets. Now you've seen the charts. You've seen how the charts work. Now you know what the charts are all about. Now you understand the mistakes that you can make on the charts. But what about the mistakes that you can make on a normal day-to-day basis when you're trading? It's all about controlling the mind, controlling your mind, keeping your mind in the right state. The psychology of trading is more important than anything else, because that is what's going to make you profitable at the end of the day. It's all about how you approach your trading, not the system that you use to trade with. And that's always the mistake that we tend to make. Now, one of the bigger issues with trading, one of the giant gargantuan issues I find with traders is they overcomplicate everything. Overcomplicating issues can be such a big issue. You overcomplicate everything. You go mad. You don't keep it simple. And then you confuse the hell out of yourself when you're trying to trade. So the simple way to do it, guys, the simple way to become profitable and to make money in the markets is this. And I'm going to keep it as simple as I possibly can. And it's to have a strategy, to have a two-step business plan. Now, what's a two-step business plan? You don't have to write this down. You have to manage your risk. You want to make more on your wins and lose less on your losses. That's the basis of making money in the markets. The basis of making money in the markets is to make more on your wins, lose less on your losses. How do I do that? How do I actually do that? Well, it's quite simple, really. Let's say you have a $100,000 account, and I'm just using that as an example. And you want to risk 1% of that account on any given trade. You can risk any amount you want. I recommend 1% on every single trade. So 1% of $100,000 is $1,000. So you're going to risk $1,000 on every single trade that you take, based on the size of your account. If you had a $25,000 account, how much do you risk? $250, not $20,000, $250. So on a $100,000 account, we're risking $1,000 on every single trade. The trick is to keep your mind in the right place and risk the same amount on every single trade. You can't change that amount. You can't do any scalping. You can't move your stop losses down or away from your losses. And you can't dollar cost average. The risk is $1,000 on every single trade on your $100,000 account. Now look at this. If you lose 10 trades, how much of your account do you lose? 10%, which is recoverable. Would you lose 10 trades in a row? In all probability, not. Usually if you take 10 trades, you'll lose 5, you'll win 5. And that's the basis of the system. Because the market's a 50-50 game, if you rely on the system to make you money and give you a 6 or 7 out of 10 win rate, then you're kind of always going to come out at a 0 because you're going to win 5 and lose 5. If you're heading for the targets that you require. If you're scalping, you can win 7 out of 10, but the 3 that you lose are going to lose you an absolute fortune. Now, how do I get into a trade where every single trade has got a $1,000 stop loss or a 1% stop loss? First thing you do is you look at the trade you want to take. You say, I want to take that trade. That looks like a great trade. And then you say, where am I going to put my stop loss? Where am I going to put this stop loss? And I call it an invalidation area, an area where I look at the trade and I say, if I see the price at that point, I know this trade's invalid. I know there's no way I would take this trade. So in other words, if the price is there, this trade is dead, gone, history. It is no more. It's over. That's my stop loss. Then I say, okay, I want my stop loss in that area. Now what I do is I work out how much is $1,000 back to the cost. How many contracts can I buy? How many points can I buy? How many pips can I buy? Whatever you want to call it. How many lots can I buy, for example? Then you work that back. Now you've got the size of your trade. It might be 20 lots. It might be 2 pips, whatever it is, whatever you're trading in. Now you know the size of your trade. Your stop loss is there. It's $1,000 to stop loss. Now you just make sure that the win is bigger than the loss. In other words, you can't be aiming for $50 and then you're losing $1,000. That doesn't work either. You want to be aiming for $2,000 or $1,500, and then we can get the big amount. That's what we're looking for. If you see that you can't actually make more than you're losing, the risk to reward's not there. The trade's a waste of time. If you're looking for a 2-to-1 trade, if you're looking to win $2,000 on a $1,000 loss, surely the $2,000 that you're looking for has got to be achievable. It can't be so far out that you're never going to reach it. And you can't just put targets there for the sake of putting targets there. The target's got to be achievable. You've got to look at it and say, this trade could make that profit. The trade will make that area, because if I look at the lines, it's going to take that distance. It's going to make that money. Now you've got a trade that's possibly going to make you $2,000 and lose you $1,000. The next part of the trade is quite simple. All you've got to do is say, well, how do I manage this trade? Well, when it goes into profit, like $800 into profit, sit on your hands, don't take the profit. Take the stop loss, move it up to break even or even into slight profit. And then if it comes back and takes it out, come on guys, if it comes back and takes that out, it's kind of an invalid trade anyway. I mean, do you really want to hold on to a trade that comes back that much? And then if it gets further up and it goes over the $1,500, you move it up to $1,000 in profit, maybe follow it $500 behind, all the way up until it's at take profit. Let's say your take profit's at $2,000. At $2,000, take it all the way up to $1,900 if you want to. Let's be honest, if it comes back and takes that out, you've made target. And if it doesn't and it carries on north, you make extra money. And that's as simple as the process gets to being profitable. It's the strategy that makes you money, not the system. The mistake we all make in our minds is we believe that squiggly lines are going to make us money. We look at candles and we think these are real things, but behind those candles, behind all those bots, behind all that information are real human beings. Even if there's a robot trading, even if there's a robot trading in the market and it's out there and it's doing it all automatically for you, that is a human being that's running that behind that. Somebody programmed that, and somebody's sitting behind that bot waiting for it to make a profit for them, a real human being. Doesn't want to make a loss, he wants to make a profit. And guys, if bots were so great, if robots were so great, if these things were such a great system, then why isn't everybody just using bots? Why isn't all the pro companies and big banks and that just running bots and letting them make money for them? Because that's what they say, it's a bot, it should make money for you. Human beings make mistakes, robots don't. No, robots can't see the subjectiveness of the stock market because it's subjective, it's not objective. You're going to tell me it's mathematical, this and that and that and that. Rubbish. It's all human beings, and it's all about what human beings feel. If the Fed in America gets up and starts talking about the economy, the markets go flying up or flying down. Why do you think that is? Do you think it's because some robot is making it do that? Or because some algorithm making it do that? No, that's human beings listening to someone say something and thinking, oh, my money's in danger, let me sell everything. That's what that is. Let me buy because he's telling us the world's going to go great. And let's buy because we're going to make such a profit in the future because I've got FOMO and I need to buy. That's what that is. Anyway, guys, don't forget to come back and watch my next video, which is all about strategy. All my last videos, they'll tell you everything about strategy. I do believe that my last video was all about the difference between buying a property or buying stocks and which one's better for you. So go and have a look at that. That might be of interest to you as well. It'll tell you all about the best way to invest your money because investment's just as important as trading. Guys, thanks for watching this one. Till the next one, cheers, ciao, and bye.